On what the White House dubbed Liberation Day, President Donald Trump launched an economic bombshell that shook global markets. Wall Street plunged, stocks tumbled across the board, the Nasdaq was decimated, small-cap stocks nosedived, nearly $2.5 trillion in value was wiped out in just one day. Analysts called it worse than the worst-case scenario. This wasn't just a bad trading day, it was a structural shock to the global financial system. The cause? A sweeping new US trade policy that imposes a 10% blanket tariff on all imports. China was hit with a 34% tariff. Vietnam, 46%. Even close allies like the European Union faced a 20% penalty. Supporters claim the move is about national security, economic independence, and rebuilding American industry. Critics argue it will lead to skyrocketing prices, global trade wars, and economic pain for everyday Americans. Some estimates suggest that the average US household will spend an extra $5,000 a year because of these tariffs. But there may be another angle to this story. Some believe the tariffs could trigger deflation, slowing down the US economy enough to force the Federal Reserve to lower interest rates. If that happens, it would reduce the government's borrowing costs and allow the US to refinance its massive debt. In other words, this might be about more than trade. It could be a strategy to reshape monetary policy. So, what exactly happened? Why did it happen? And where does this go next? Let's break it down. Markets were optimistic just weeks ago. Talk of a soft landing and economic resilience filled the headlines. Then came the tariff bombshell. The S&P 500 dropped nearly 10%. That's officially a correction. But the fallout wasn't limited to equities. Credit markets showed signs of stress. Bond spreads widened. Currencies tied to export-driven economies like the Mexican peso, Canadian dollar, and Chinese yuan fell sharply. Companies affected by rising import costs began announcing layoffs. Lobbyists scrambled to win exemptions or push for policy rollbacks. Wall Street responded with fear and uncertainty. And as we know, markets hate uncertainty. This was economic whiplash. If you're finding this breakdown helpful, hit the like button and subscribe for more weekly insights on global markets and economic shifts. It really makes a difference and helps a lot. For historical context, similar panic followed the 1930 Smoot-Hawley Tariff Act. That law raised duties on thousands of imports and led to global retaliation. The result? Global trade slowed, deepening the Great Depression. This moment feels eerily familiar. The administration claimed these tariffs were reciprocal. That means if a country charges the US a tariff, we charge them the same. Sounds fair. But it isn't accurate. China's average tariff on US goods is around 6 to 10%. The US just hit them with 34%. Australia's tariff on American goods? Basically zero. The new US tariff on them? 10%. The real story is more complex. It turns out the tariff rates were based on trade deficits, not on what other countries charge. Here's how the math worked. Take the US trade deficit with a country, divide it by that country's exports to the US, cut the result in half. That number became the new tariff rate. For China, the formula resulted in a 34% tariff. For Indonesia, it was 32%. The problem? These numbers ignore the services sector of the economy: tourism, education, financial services, where the US exports more than it imports. This means the formula is flawed. It doesn't reflect actual trade relationships, and yet is the basis for what could become a global trade war. So why go this route? There are two camps. One says it's economic ignorance, the other says there's a deeper strategy, and there's precedent for both views. For decades, politicians across the aisle have criticized China for intellectual property theft, unfair trade practices, and currency manipulation. Even progressives and labor advocates have called for reshoring jobs and rebalancing trade. Trump has made these arguments for over 40 years. He believes America has been ripped off. But now there's a new theory emerging. Let's talk timing. The US government is paying nearly $1 trillion a year in interest on its debt. That's because interest rates are at their highest levels in over a decade. And high rates make it expensive to refinance debt. Trump's background in real estate taught him one thing: refinance when rates are low. So, what if the tariffs are designed to intentionally slow the economy? If growth slows enough, the Fed could be forced to cut rates. That would reduce borrowing costs and allow the US to refinance trillions in debt at lower rates. It's a risky play, but it has logic. Even Wall Street voices like Howard Lutnick say these policies could trigger a recession. And recessions typically lead to interest rate cuts. Historically, the Reagan administration used rising deficits to justify rate adjustments and currency negotiations with foreign governments. Could we be seeing a modern echo? Legendary investor Ray Dalio has warned about this kind of tactic. He says tariffs can raise government revenue, protect domestic industries, disrupt global capital flows, spark stagflation, low growth plus high inflation. But he also says they can force central banks to intervene. And that may be the real endgame. Dalio believes the global monetary system is overdue for a reset. That means shaking up the status quo. Tariffs, in this view, are just a tool to accelerate that process. He points to the cycles of global empires, where debt, monetary inflation, and internal division all reach a boiling point. We may be entering that stage now. So what happens next? If the economy slows, the Fed might cut rates. If that happens, debt becomes cheaper. Markets might even rally. Production could move back onshore. Supply chains could become more secure. The US might even regain some manufacturing dominance. Or we could spiral into a global recession. Retaliatory tariffs could snowball. Consumers worldwide could see prices spike. Developing nations could face currency crises. What we know for sure is this. This policy will affect everything from your grocery bill to your 401k. It will ripple through every market, industry, and portfolio. The only question is whether it will be short-term pain for long-term gain. Or just pain. We don't know how long it will last. But one thing is clear. Tariffs are no longer just about trade. They're about leverage, debt, and global power. And Liberation Day might be the start of an entirely new economic era. If you're finding this breakdown helpful, hit the like button and subscribe for more weekly insights on global markets and economic shifts. It really makes a difference and helps a lot.